Earnings reports still coming in thick and fast. Let's take a look now at the insurance sector. Definity Financial just wrapped up a huge acquisition valued at more than $3 billion of Travelers Canada. The company just reported its numbers, its actual fiscal Q4 numbers. We're joined by Rowan Saunders, Definity's CEO. Great to see you. Thanks very much.
Thanks for having me.
Stock down a bit, but it's a down day for the markets.
Yeah, I mean, I think that we released our earnings last night, and obviously the markets are a little different today. But I think the main message, from us as we released our Q2 earnings for this last quarter was very good. We're very pleased with them. Good top line growth, good underwriting margin, so everything on track for guidance for the year. And
your net operating income per share, which is the metric that analysts, it looks like they follow, 95 cents a share, whereas consensus was about 89 cents. So you beat expectations.
Yeah, we have. And I think that when I think and I unpack the results for this quarter, revenue continues to be very good. We're a growth stock. We tend to grow faster than the marketplace. And then the underwriting contribution has been pretty good. We have good pricing power in the margin, good underwriting segmentation. And so that was better than we had previously expected. And then the other contributions for us are distribution income through our broker platform and net investment income. When you put that all together, you get our operating income, which is really progressing quite nicely.
Just remind us what the combined ratio is. This is the profit on plain old underwriting.
Yeah.
And it came in at just over 90% in the latest quarter.
Yeah, that's right. And so for every $100 of premium, you pay out claims and operating expenses, and the difference is your underwriting profit. And what we try to do, our guidance is that we could grow our business at about twice the rate of the industry, and we would operate at a sub 95%. So 95% or better, varies by quarter, underwriting results. And so we compound that underwriting result.
So you want that combined ratio to be as low as possible?
As low as possible would be more profitable for us.
Now, you had a tricky Q3 because of catastrophic losses. What was that? Can you remind us? Was it fires or floods?
Yeah, this goes back to last year. So last year, the Q3 of last year was actually a record year for the industry. The industry had significant events. There were primarily forest fire events. There were some flooding events as well. And 2024 was actually a record year for nat cats for the industry. That's part of what's keeping the market firm as we go through 2025.
Oh, I'm sorry. Yeah, so that was Q3 of 2024
last year.
Was the floods and the locusts, etc.
This last quarter has actually been pretty good. I think that we're slightly better than our expectations in terms of nat cat events. But look, these are fortuitous and they're hard to predict, but they typically tend to occur in our industry in the second or the third quarter of the fiscal year.
And personal property is pretty profitable, it looks like, in terms of combined ratio. It's 83%, roughly, 82.8%.
For that previous quarter. And yes, I think that what we've done there is we have used the sophistication of underwriting models trying to predict which areas are more prone to nat cat events than others. And as I said, there's good pricing power in the industry, so that's driving our rates. And even when you go back to last year, we had very strong underwriting results despite record nat cats. That's continued into this year. We had a real winter this year, so the first quarter we saw lots of frequency of a real Canadian winter. But as we've moved into the second quarter, it's been so far pretty benign.
When you get a rough winter, is it car crashes, things like that?
You get more frequency of car crashes, and so you have more snow load, so you have some collapses, and you definitely have more frequencies. As you get into the second and third quarter, it's more extreme wind events, forest fires, and some flooding.
Your dividend yield only about 1.2%.
Yeah.
Would you ever up that to, say, the level of a Manulife or a Sun Life? I know they're very different companies.
Yeah, I think for us, our philosophy is to progressively grow our dividend. We have moved it up last year. We moved up 17%. It's still a relatively low yield, and I think that goes back to the strategy of our business. We went through demutualization to become a public company so we could grow. And actually, that takes us back to one of the questions you asked about the highlight of the quarter, was not only these good financial results, but also we acquired the Travelers business.
Yeah, talk to us about that.
And so for us, this is about putting our capital to deploy in acquisitions as opposed to primarily trying to return it. So the acquisition of Travelers is very exciting for us. Travelers is the 12th largest insurance company in Canada. if you think about our story, when we went public, we were the 8th largest. We organically grew to the 6th largest, and now pro forma with Travelers will be the 4th largest P&C company in Canada. We get about $1.6 billion of revenue from Canada. About $1 billion is from Travelers Canada.
Yep.
About $1 billion is in personal lines. It adds scale. We move that onto our platform.
Yes.
And about $600 million is in commercial lines. And we really like that. Lots of talent that comes with the business, good broker relationships, some product expansion. So strategically, one of the things that we're trying to do is build a leading Canadian company, a Canadian champion, and we're well on track. Our story is good organic growth. We think we can grow at about twice the rate of the industry, and then deployment of our excess capital into acquisitions. And Travelers is our first major insurance company acquisition. So it's going well. We're waiting for the customary regulatory approvals. So we expect to close this in early next year.
What percent of your business is through brokers? Do you sell directly to consumers at all?
We do both, but it's primarily intermediated. About 90% of Definity's business is sold through our independent broker channel. We do have a direct-to-consumer brand called Sonnet. It's a digital insurance company, one of the leading digital companies in Canada, but it's only about 10% of the company's revenue.
Do you get a bit of extra margin there, I guess, because you're not paying commissions?
There's a different economic model, and certainly the commissions you don't pay, but you then have to pay for marketing expenses. With scale, we think that model operates at a lower cost structure than a traditional intermediated model. But also there's a generational divide, and more people are more comfortable looking and shopping online. So we're in both channels, which I think bodes well for the future.